right, what do you guys say? We ready? So we are back live for the afternoon here. We have the FOMC Fed interest rate decision here in 10 minutes. Okay, here's the schedule for the afternoon. That interest rate decision is going to hit at 2 p.m. Eastern, 1 o'clock Central, 11 a.m. if you're on the West Coast. If you're lost in the mountains, that's going to be noon. Okay? Then, when that hits, we then have 30 minutes for the market to digest, and after that, Powell will come out and speak at approximately 2:30 p.m. Eastern, which we will be watching here on live and watching the market alongside it. All right, hey, if there's some trades, we're going to go ahead and take them. Those of you guys trading take profit trader, you are not allowed to trade the FOMC interest rate decision. You need to be flat. And I would say at least 5 or 10 minutes surrounding 2 p.m. Eastern. All right? There's the schedule here. I'm not afraid to trade the aftermath. Okay, I do it relatively consistently. We'll see if the aftermath price action is reasonable. All right, so let's take a peek. And I'm excited, man. Now, the forecast for the interest rate decision. First of all, let's take a look at the poll that I started in the chat. What are you guys thinking? All right, so far you guys are aligning with the expectation. The expectation is that they're going to cut rates by 25 basis points. Okay? Now, if they do nothing, the market's going to lose its mind. I heard recently, by the way, like 10 minutes ago on Bloomberg, somebody brought up the idea of a 100 basis point cut. Now that was quickly shot down, all right? But in my world, there's really 3 options. No change, which would be crazy. 25 basis point cut, which is by far the most probable outcome. Or a 50 basis point cut, which is low probability, but the market would also probably get very, very volatile if that ended up being the case, which, hey man, we'll take it. We'll take volatility. So, I'm excited. Let's see here. We are 7.5 minutes out from the interest rate decision, and I'll get that to you as soon as I have it, which should be pretty quick. How are you guys trading? By the way, since we got off live about an hour and a half ago. We finally got a break out of that little range, huh? Not bad. Kind of a fake out downside, fake out back upside. Yeah, man, I mean, heading into FOMC, you're probably going to get a lot of this. Market's waiting in the shadows. Scott, couple of green trades. Good work.
They're talking
all right, let's get our audio check. How's the audio?
Market near all-time highs, investment-grade credit spreads near multi-decade tights, and yet we're having a conversation about whether this Fed, in 7 minutes' time, will cut interest rates by 25 basis points or 50. Subhadra
all good? All right, gotta make sure it's good.
Subhadra,
it's been a little while since we've brought in the 50
basis point view. Is that what you and the team are looking for, and ultimately why?
So I think the spirit of the call from our economists is the fact that given the information we have on the job market and the revisions, quite dramatic, the Fed has some catching up to do. So the idea is that the Fed is going to have to front load some of these cuts between now and the end of the year. So whether it's a 50 basis point cut at the September meeting and then another 25 basis point cut. Or
I don't know about that. Listen, if we get 50 basis points, I'm gonna lose my mind because we're market people, right? We love it. We'll deal with the inflation later, which of course, not a great long-term play. But I don't know, man. To be going on Bloomberg saying they're gonna cut by 50, that takes some guts. If they do, I will happily eat my words. But right now, the expectation is a 25 basis point cut. I gotta tell you, if they don't make a change, Powell might be losing it or something. But we will find out here. 5 minutes out. 5 minutes out. Usually it drops very much so on time. Now again, as you guys pour in here, those of you guys who are trading with Take Profit Trader, you cannot trade this, okay? You gotta be flat. Get flat, like now. We'll wait until afterward, and then once the actual decision is out, you're free to rock and roll. But remember, then Powell speaks at 2:30 Eastern. Gut says no change. Wow. 18% of you guys think they're doing nothing? Only 61% say a 25 basis point cut. Let's see here. Okay, so according to the CME Group FedWatch probabilities, these are rate probabilities that are basically priced in via futures. According to that FedWatch probability, you guys are way off. The probability of a 25 basis point cut is 95.8%. 50 is 4.2%. They are not even pricing in the probability of no change. But you guys go big, I like it. All right. Two minutes. All right. All right. Hey, last reminder. Last reminder. If you're trading with Take Profit Trader, you need to get flat now or you're losing the account. Okay, you're not allowed to trade this decision drop with Take Profit Trader specifically. Yeah, Tank says anything other than a 25 basis point cut will create whiplash. I agree. Anything other than 25 is very much so unexpected, and the market does not like unexpected as far as keeping volatility timid. Though I'm not very, against. If we get volatility, let's get it, man. 50 seconds. All right, 15 seconds out. As soon as it comes through my newswire, I will let you guys know. Make sure you're flat. Here we go. 25 basis points. That is as expected. Okay, so about 40% of you guys were wrong. So that's going to be as expected. Again, if you're just joining us, the Fed is cutting interest rates by 25 basis points. That is as expected. We basically had two other semi-realistic options. Number one was a 50 basis point cut. That did not occur. Number two was no change, which would have had everyone, I think, a little concerned for Jerome Powell's mental health. So, 25 basis point cut is what the Fed has decided to do. We will now have Powell, and that, by the way, that is as expected. Powell will be out speaking here in about 29 minutes. We'll be covering it live right here. So stick around, and we're gonna, hey, listen, if there's trades between now and then, particularly while that's going on a little toward the end, we're gonna take them.
And just say, in considering additional changes to the target range in the future, they will consider all kinds of options. There is no real change to their economic forecasts, but we don't know exactly why that is, whether it's because Myron contributed different numbers than others, or Anna Paulson, the new Philadelphia Fed president, contributed different numbers than others. But the growth rate is marked up for this year to 1.6% from 1.4%, and the unemployment rate is unchanged at 4.5%. PCE inflation at 3% is unchanged from their July forecast, and core PCE inflation unchanged at 3.1%. There's no...
Okay, we'll bring that back in periodically, or particularly we're going to watch Fed's speech together here. Between now and then, we got to focus on the market. So, those of you guys trading take profit trader, you should. I had to double check in case they made a change. Yeah, you should be free and clear to rock and roll here. What they don't want is basically the 2 minutes, 3 minutes, maybe 5 minutes surrounding that. I usually go 5 minutes around it to be safe. The news event that is forbidden to trade at Take Profit Trader. So that has now passed. Again, if you're just joining us, the Fed has cut interest rates by 25 basis points. That is as expected. And we will have Powell out here speaking in 27 minutes. Volatility not tremendous here out of the NASDAQ. We're looking at a 5-minute NQ chart. This is the newer December NQ contract. And we are getting a good push, but when you get the as expected result, this is actually reasonably controlled. Javaz, Nico bought 5 Take Profit Trader accounts using code BIG. Good work, brother. Yes, they are 40% off, no activation fee right now with code BIG, B-I-G. All right, let's watch how this bar closes up. We are 60 seconds away from a close on this 5-minute bar here on the December NQ contract.
Even allowing inflation to run hot, and they will keep cutting despite that inflation. That is what is getting translated into this market.
I want to cross back over to Mike McKee if he's still with us and hasn't run off to the news conference just yet. Is Mike there? Good. Mike, I want to come back to you. How original is to see this, to see a rate cut, to see the projection of more to come, at the same time all these other things are happening with the forecast? How can you explain that?
Well, I think there's two possibilities, and they both center around the new members on the board, Anna Paulson from the Philadelphia Fed, and most probably Stephen Myron. When you look at the range of the forecasts for GDP, they moved up the bottom range and the top range.
What a push here out of the polls, man. This is good. This is good. I got to tell you. I know people like to think that the same thing doesn't repeat itself, but all history does is repeat itself, especially when it comes to economics. As these rates start coming down, It's going to take some time, but guess what's going to start looking really tempting? As these rates start coming down, inflation hits the goal, stays below the goal that the Fed set back in 2022, that 2% goal. Cheap money is going to start looking really tempting. And you know what happens when cheap money is in play? Traders make a lot of money. At least traders with edge. That's what happens when cheap money is in play. Okay, now when the Fed has to choke the economy out like they've been basically doing since 2022, it's been a little bit better as of late, of course. But like 2022, when they start choking it out, the market is a little bit tougher to squeeze your piece out of. So all this to say, what the hell's my point? My point is, I'm going to go ahead and take the bet that we don't necessarily learn our lesson and cheap money is back in play within the next decade. And that's going to be the time. That will be the time heading into that. Maybe a couple of years as we get closer and closer. Obviously, you want to be set in stone doing your thing while it peaks. And then the change that a lot of people missed from 2021 to 2022 because of everything going on, you're going to want to be able to maybe see that coming because we've been through this before. As inflation starts to run again and the Fed comes out and starts saying, hey, we got to take rates higher, we got to choke this thing out. You see that happening and you're able to play it differently than you did in 2022. Late 2021, 2022. You're going to get another shot. And this time, you're going to be ready, which is a beautiful thing. All right, we've got Powell coming out here in about 22 minutes. And he will be talking, contributing to volatility here. So between now and then, we got to keep our eye on this NASDAQ. We have less than 2 minutes left here on this 5-minute bar. Again, we're looking at the December contract on NQ. That's NASDAQ futures. Let's see how this bar closes up. This pump is essentially attempting to round trip right now. We'll see if it can. It's good to see some volatility, that's right. John, how we doing?
Two, suggesting nothing. And then also the fact that 2 rate cuts were pulled forward into this year. We thought there would just be one more for this year, so more or less where we were last time. It tells me that this is a Fed that locked arms, felt this was time to reduce policy from what was surprisingly restrictive to them. They were probably shaken by the labor market revisions and thought, wow, we've kept policy a lot more restrictive than we thought. Let's start getting to neutral and let's do it in unified fashion. I think this is good for the markets.
Bob, good for the markets.
Yeah,
let's talk about which ones.
And you know what else
it
it's
might
good
be
for?
Risk assets.
Because when we get to
How much
neutral,
can this keep
people
being
can't help
supported?
themselves. People can't help themselves. Humans cannot help ourselves. So when you get to neutral, you start saying, what if we just dipped a bit beneath? Cheap money, baby. That's when traders get rich. You can get rich anytime. But when cheap money is in play, I'm telling you right now, you want to be ready, and it's coming. Not in the next month, but we're going to see another maybe. I don't like making the comparison to 2020, 2021, but we're going to, because that was just kind of a bizarre time in entirety. But we're going to see another cheap money era, and when it does come, you're going to want to be ready. And this time around, you'll be ready because you've seen it. You've seen it. From 2020 to 2022, you saw the cycle. It happened quick, and it was brutal. It was aggressive. It rug pulled a lot of people. NQ giving back the entirety of the move. We round tripped, baby. Let's see here. Again, hey, we got Powell coming out in less than 20 minutes, about 19 minutes. We're going to be watching it here live. Wow. Wow. Okay. Okay, so hang on now. We just saw the Fed lower interest rates by 25 basis points from 4.5% to 4.25%. The dot plot. The dot plot shows, there are no names attached to the dot plot, but it shows what committee members are looking for by year's end. Okay? We're at 4.25%. We just lowered by 0.25%. That's 25 basis points from 4.5 to 4.25 for rates. There was one dot on the dot plot. Not by the end of 2027. Not by the end of 2026, but by the end of 2025, 3.5 months out, less than, is looking for rates below 3%. There was one dot. We don't know who it came from, but that is incredibly aggressive. That's actually very interesting. So maybe we'll get some insight to that from Powell here. Actually, we likely will get a little bit of insight to going lower than originally expected by year's end out of Powell here when he comes out to speak in about 15 minutes, 16 minutes. Look at this push! Bears taking control. That is low of day here out of NQ, NASDAQ futures. We have completely round-tripped the original pump off of the 25 basis point expected cut to interest rates, and we are now sitting at low of day. Wow, what a push. 45 seconds left here on this 5-minute bar. Goodness, that is a 200-point move in the last, 10 minutes. Did anybody catch that? I know somebody watching is probably diamond handing that motherfucker. What a push. There's a new 5-minute bar. Over 200 points off the highs now. Off the highs here, just since that 25 basis point cut from the Fed. Powell will be out in 15 minutes talking. All right, Bull's trying to bounce this baby up. We still have about 3 minutes left, over 3 minutes left on this 5-minute bar. Then Powell, if you're just joining us, he will be out speaking in 13 and a half minutes. All right, we're going to let this market work itself out. I will be back in a couple of minutes. Remember, we have Powell coming out in less than 15 minutes to make comments. We're going to be streaming it live here. Be right back. Okay, welcome back. We are less than 9 minutes out from Jerome Powell coming out for his press conference, his speech, to give some context on what we just got, which is a 25 basis point, as expected, rate cut out of the Federal Reserve, FOMC. Market is trying to push lower. We round-tripped times 3 that initial pop off the interest rate decision. So let's see if Powell can come out and maybe talk this market up a little bit. Whatever ends up occurring here, volatility is tremendous, and I am loving it. I know some of you guys are trading this thing. You're micro scalping this baby. How are we doing? All right, new poll here. Time to start thinking about Powell's speech. What do you guys think? How is the market going to react to Powell talking? From the time he starts to the time he's finishing up. Bullish, bearish, or flat? Market right now coming right back into kind of the midpoint of this entire volatility. Right there also happens to be the 20 EMA here on the 5-minute chart. Again, we are looking at the newer December contract for NQ. That's NASDAQ futures.
I think for the near term, it's pretty clear. They talked about increased downside risk to the labor market. And so this is all about risk management. It's not about modal forecasts at all. As you noted, growth is stronger, the unemployment rate unchanged for this year, inflation unchanged for this year. You can see it at the back of the SCP, their forecast. There was a little bit of a shift in the distribution of risks. Those officials that are more worried about downside risk to the labor market, less officials that are more worried about upside risk to inflation. It's basically in line with what we were anticipating. The Fed shifting in a little bit more dovish direction today, close call on the 2 versus 3 dots. I think the key question for Chair Powell is how much does he lean into the near-term signal of cutting at each meeting this year?
Do you get a sense, Matt, of how much the reaction function has shifted? John's done a really great job of talking about how from July to August, there seemed to be a shift from the unemployment rate to the headlines, payrolls report. Do you have a sense of just how tolerant this Fed is going to be of inflation well above 2% for years on end and keep cutting?
Look, I think they're showing us that they're pretty tolerant above target inflation. In fact, if you look at their forecast for next year, they actually raised their inflation forecast by 0.2. They raised their growth forecast. They lowered their unemployment rate forecast, and yet we see a lower Fed funds rate. I think the reality is we are now projecting at 5+ years of inflation being at least 50 basis points above their target, and yet they are cutting rates into that environment. So I think it's a Fed where...
Yeah, it lags, right? So still at 4.25%, like, it lags. It doesn't mean when you cut 25 basis points that it stops working on inflation. The Fed is doing their best to not be early, but time it so that inflation still comes into its target, but we can ease up on the pain of higher interest rates as soon as we possibly can. The Fed, however, is not willing to risk cutting early. So if they're cutting by 25 basis points, it shows that not only are they taking pressure off themselves, because everybody has been yelling at the Fed to cut for quite a while now, but also it seems that they have the confidence to do so. Because the worst thing the Fed can do, their number one concern, is to mess up steering the massive freighter cargo ship that is the U.S. economy, which means they're not going to take unnecessary risks. So them cutting 25 basis points, while it may seem early to some, a lot of other people would also argue it's late. I tend to believe this is kind of right on time. But looking at the Fed dot plot, the FOMC dot plot, with one of those members, whoever it may be, wanting below 3% rates. We're currently at 4.25%. Below 3% they want by the end of 2025. I don't know. That Fed seems to be leaning toward maybe a repeat cycle over the next few years, maybe 5 years, of getting back to cheap money. Once inflation hits their target, they can pat themselves on the back, say, job well done, and we can get back to the tale as old as time, which is cheap money, cheap money, cheap money. Everyone gets rich. Inflation hits. The smart rich protect themselves while everybody else kind of goes belly up while they hike rates to take care of inflation. It'll happen over and over again. The question is, do you take advantage of the next cycle? All right, Bulls trying to take this back up. We're kind of right in the middle of this volatility since we got the 25 basis point cut rate decision. Now, we are 2 minutes out, by the way, from Powell coming out and speaking, assuming he is on time. All right, 60 seconds out here from Powell.
No, absolutely, and I think this is the
So,
world.
let's bring him in.
This is the investment realm that we
And I will
have
cover
to deal with.
the
And so
full
it's not
Powell
gonna change
speech here
anytime
live.
soon. But this was an incredibly dovish.
Let's see what kind of context we get.
And the markets are
Waiting on
responding.
Powell any
We
minute
don't
now.
know for sure
30
who's that
seconds
dog,
until the
who
scheduled
that
time.
dog actually belongs to.
We'll be out any
at the
second.
Federal Reserve. You can have a decent guess. Sure. They're not going to tell us. But here's my point.
I bet you $10.
It would be a mistake, I think, to say, that's Governor Myron, it does not matter. Isn't that a hint, a flavor of what could be coming further down the line in 2026? Isn't that ultimately what the Fed share doc could look like in the next 12 months?
This is
Get your votes in, by the way, on the poll that we're currently running in the chat.
Market activity, people are putting a disproportionate
What's the market's
amount of weight
reaction
on that dot
to Powell's
and
speech?
on the
Bullish,
view,
bearish,
on
or
the
flat?
dissent, because it is a flavor of who that new Fed chair could be.
We're close to
Looking from about right
as
here,
I can.
from the time he
markets
starts
will
speaking.
police the politicians.
Where does he
in
push
Washington.
this thing?
TK, you say that. Look at what this Fed's just done. It's revised higher its inflation forecast and just cut rates.
But we are,
Is
as
this
he
market
correctly
pleasing
said,
them?
Greg said, we're above the neutral rate substantially. They got
I agree
wiggle
with
room
that.
here.
This decision is the easier decision. Without a doubt, we're on the same page on that front. But if anything, you could talk about this Federal Reserve falling into the hands of political actors. This Federal Reserve hasn't hit its inflation mark for years, led by the chairman of the Federal Reserve, Jay Powell, who stepped into the room. Let's take a listen to the chairman of the Federal Reserve.
Here we go. Here's Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months.
Putting the market to sleep here.
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case,
I got to tell you, I think when 2020, the end of 2027,
and they're not
and the beginning of 2028 hits,
policy is not.
I think they're going to revise that
course.
down because people can't help themselves.
The Fed has been assigned 2 goals for monetary policy:
G-money's
maximum
coming.
employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, great. And then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also
the range here, by the way, we're looking at about a 200-point range on NQ.
Unemployment, but that I would say if you're looking at
usually this is kind of the time
more about the change in immigration.
Where
so
any additional volatility is going to be a wild card statement from Powell. Like if we take out these lows and push another 150 points, he probably said something that we weren't expecting. But let's see if the market kind of stays within a 250-point range here. If so, but volatility keeps up,
typically when we say things
a
are
little bit, ATR current on the 5-minute chart is just under 60, 55 now.
Both supply and demand have come down quite
sharply.
sharply.
Have some trades to put on.
Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Thank you.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted?
Here.
And how seriously was that option entertained at your meeting this week?
This is important.
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are
attempts to take out the
maybe
lows.
not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than
taking out
previously
low of
expected
day.
by the
Trying
end of
to,
next
at least.
year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because
we're just now getting to the
market
period,
is
by the way,
softened,
where I'm
GDP
willing
growth
to take
has
trades.
slowed.
HR 62, that must be considered.
So
That's
I
very
would just
high.
say that the risks there have
Powell
been
gets
less
asked a wild card question. We can see that
than
increase
one might
again.
think. And in terms of
If I see a good
the
entry,
labor market, what we're seeing
I will be putting
is
it up.
unemployment is still low. It's
me.
still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
If I could follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility
Market currently at intraday
for you
lows
in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast.
Do you imagine he said those will turn out to be transitory?
I don't think just assume that though, right?
I don't know if Powell is too fond of the word transitory anymore.
What happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once.
Yeah, ATR 64.
What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market
there's a
for
lot of
households
factors.
at home,
Prices
especially
can
younger
move up
Americans struggling to land a job?
Due to another outside factor,
labor
and
market,
policy
and
can still be doing
obviously
its proper job.
We think it's appropriate that we reduce
it's not one-to-one
our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months, and it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. and as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability, and so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for
I think Powell would be a hell of a trader.
Question was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with
Politico. Market at lows, making new lows here.
A lot about
Keeps
Fed
pushing.
independence and the importance of it over the years. But as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So,
people think that there's a lot of, political agenda when it comes to
the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do.
People like to hit on the guy.
We don't frame these questions
Powell has
at
done
all
a tremendous job
in terms of political outcomes. I think when you get to another part of Washington,
he gets pressure
everything is seen
from the
through
entire
the lens
world
of does it
to do
help or
things,
hurt this political party,
and the
this politician? That's the framework, and I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective.
But I don't think you can say he has not done that.
We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the fear of
Okay,
labor
quick market
statistics
update
really
here. We're
doesn't
looking at the
understand
5-minute
this, and
chart on the
hard to
newer
fix it. It's got to
December
do-
NQ
of
contracts.
course,
So
it
these
has
are
something to do
NASDAQ
with
futures, and this is the
low response rates, but it's
5-minute
also got to
intraday
do
chart
with
here.
what's called the birth
We've been
and death
getting
model.
loads of inside
Because
closes.
a good
The
amount of
average
job
range of a
creation
5-minute bar is currently
around
68 for
new companies
context.
and how many go out of
Shortly
business,
after
how
the
many are
opening bell
founded.
this morning,
And it's
that
just really
ATR
hard.
was
You
20.
can't survey for that.
So
You've
we
got
are
to have a
over
model
triple
that
the
predicts that.
volatility currently that
It's
we were
quite
seeing
difficult
off
to do,
the
especially
open
when
of the
the
New York
economy is
session.
undergoing big changes.
So a lot of
and
inside
they've been
closes.
working on that and are making progress on it. But
No entry for me here at this point, but
is still
again, I'm very much so
good enough
not
for us to do our work.
against or scared to trade
to the
the
extent we
aftermath
have
here. I
issues
just need
around
something
data
more
right now,
definitive.
it's
This
about
right here
low
is a lot of
response
bouncing
rates.
around.
That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data; it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know.
Damn straight, Powell.
All I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 1/4 percentage point now is going to arrest that?
Well, I didn't say that I thought a 1/4 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations.
A big bull push here, making a test of that 20 exponential moving average, which is a self-fulfilling prophecy here on the 5-minute chart. Again, these are NASDAQ futures.
To support the labor market when we do see signs like that. I did mention that. You see minorities, unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side.
Powell says Nico, how do you plan
higher
to trade this
income
market?
groups.
Same as always.
Do you
just
feel
looking
that
for
that's
price
an
action setups here.
unsustainable
But everything
mix
right now,
for the economy
a lot of
moving
inside
forward?
closes. Only
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So I think the economy is it's moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank system, Federal Reserve system, and at the board. Are they the right size? We're actually going through a 10% head.
Good bull push here. Let's see if they can take out this little wick high and shoot any idea of a little range in the foot.
All the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Neil. Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty
around
that.
Not yet, and but it will not look worse. It will look better.
View,
It'll just
which
look
is
different.
Also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than
what AI is going to do for
that may be part of the story.
The labor market in general.
It's also part of the
it's
story
going to decrease
that job creation more broadly has slowed down. The
widely
economy
thought
has
of as
slowed
boring
down.
jobs, data entry,
and
things
so
like that,
it's
customer
probably a number
support.
of things, but yeah, it
will greatly
probably
increase for a
factor,
short
hard to say how
while
big it is.
the demand for physical labor. If you're a healthy young person,
thanks, Mr.
the
Chairman.
demand for physical labor will be much higher. You'll likely make more money if you're willing to do it.
Showing up in inflation?
And then by the time that AI-driven robotics are a reality and in mass production, the AI industry itself will create many jobs. Don't be scared of
goods
AI.
inflation was negative. If you go back 25 years, that was the typical
Even if it does over the long term,
goods
take
inflation
your job, you will end up in another position that
prices
pays you more
generally
money.
went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation.
Less than a minute out, by the way, on this 5-minute bar.
Goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing.
Watching this wick higher, my cursor is
all of those companies
rollover,
and entities in the middle. They'll tell you that
close.
they have every intention of passing that through in time, but they're not doing that now.
Also, by the way, shrinking bull body compared to this previous very, very
been pretty
large
small.
bar,
It's been
ATR
slower
70.
and later.
You're on the 5-minute chart. That's a tremendous ATR. It's 3.5 times
than we
what it was
thought.
this
But
morning.
the evidence is very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Come on, Powell, stay put.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House.
Well, good thing it's not their arena.
Markets and the public
they don't run the show.
Interpret, some of his speeches, for example, and then some of the forecasts that we see today. I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 19 participants, of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution. If that's in the DNA of the institution, that's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the
halfway through
Federal
this 5-minute
Reserve
bar,
when
by
it
the way.
comes to doing what's right for the economy.
Shrinking
Why
bull
do you
body
think
as the
that
curve
is,
sits.
and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So
finally, someone asking the important questions.
A wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things.
By the way, 60 seconds left on this 5-minute bar.
I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's
okay, so you see this shrinking bull body, third bull body in a row, second shrinking bull body in a row, and this one has a big old tower up top, big wick.
It's not a bad economy or anything like that. We've seen much more challenging economic times, but from a policy
either the bulls are starting to hesitate or the bears are stepping in. All else with the bulls helps
challenging
so
to know what
we're watching this wick high.
There are, as I
Let's see if the
mentioned
bulls
earlier,
can take it up through there. Here comes the test.
it's not incredibly obvious what to do.
Not be,
so
all that surprising if the bulls pop
keep our
through
eye
and
on
fade
inflation.
back.
At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Archie.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen.
Looking at a big range,
so
maybe 280
I don't know that you
points.
see a big tension there, but it's gratifying to see that economic activity is holding in. It's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So. We watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity. So it's
okay,
at the
the
very
20 EMA, by the way, on the 5-minute chart. This is a 2-minute chart, but on the 5-minute chart, it's right at 397.
When the pandemic hit,
so I'm going to keep an eye on this next 2-minute bar. We're a minute 45 out, and we are 44 seconds away
were
from the
incredibly
rollover on the
grateful,
5-minute
and
chart.
It was really, they said that was the only thing that kept them going was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot for the big changes in rates for the to
No,
matter a
you're
lot for
open
the
to
housing
trade on
sector.
take profit trader by
And
now.
the other thing is by
They
achieving
did not want
maximum
you
employment
trading
and price
1
stability,
minute before,
that's a
during,
strong
and after
economy. That's a
the
good
FOMC
economy
interest rate decision
for
release,
housing.
which was at 2 p.m.
And
Eastern.
then the last thing I'll say
if you want to trade while Powell was talking,
you know,
may.
there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and you know, all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
You know, forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well,
good question.
I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. You know, the level of runoff is not very large. So I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices.
Market
but
making
also
a test of
moderate
the
long-term
highs here,
interest
by the
rates.
way.
So what does Congress mean by moderate
little flat
long-term
top up
interest
here
rates?
since
How
we,
should we understand that when we
since
see
the
the
25
10-year
basis point
Treasury
cut
moving?
was announced.
And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So
let's switch over
that's
to the
where that
chart
is.
here.
And there's no thought of
2 minute.
As far as I'm concerned, there's no thought of considering that considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, And that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on
December
inflation
NQ
expectations?
futures contract.
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
That wraps up the news conference with Chairman Powell down in Washington, D.C. Here in New York City, we're reacting to a 25 basis point rate cut from the Federal Reserve, a dissent pushing for 50 basis points, and a huge debate about the future. Anna Wong of Bloomberg Economics with this to say.
Well, what do you guys think? My thoughts on this are as follows. A lot of people are going to say the Fed's so late to cutting. You have to understand that there's a certain, and this doesn't matter. It doesn't matter doesn't matter what party is in office. Every president, if I were president, I would want the same thing. You want cheap money because it makes you look tremendous. Because the general population does not understand the difference between the political party in power and Fed monetary policy. They just lump it all and give all the credit to the president. That's the reality. That's today's general population. Can you blame them? Following all this takes a lot of energy. So, if you're president, you would be begging the Fed chair to lower rates, whether it's publicly or behind closed doors, because all it does is make you look good. Okay, so all of that pressure aside, the Fed is doing their job based on the data, and Powell has always undoubtedly done a tremendous job of tunnel vision, staying focused on the plan, ignoring outside pressures from either side, whether it's you need to raise more, you need to cut right now. They're like, we're just going to do what the data says. And the committee does, when they're led by Powell at least, does a great job of doing so. So, you might think they're early, you might think they're late. I tend to think that when steering the U.S. economy, today's 25 basis point cut is kind of right on time. Now, inflation might continue to creep up due to outside factors, but those are outside factors. You need to throw it all in the cauldron, and you can have cuts going on, small cuts, 25 basis point cuts, even with inflation going upside a little bit, with the expectation that those outside factors are eventually going to teeter and inflation will come down as expected because you're loosening up policy. As you raise rates, you're tightening, you're choking out the economy, which is how you cut down inflation, necessary to do, right? Now, as the Fed reaches its 2% inflation goal, maybe by the end of 2027, mid-2028, I think we're going to see revisions downside as far as where interest rates should sit, because people cannot help themselves, and cheap money is wanted by everybody with money. Because what happens when money is cheap, when interest rates are low, either neutral or especially below neutral, people with money just get richer. Okay, so these people cannot help themselves. So, cheap money is on the horizon, I think, in the next 5 years, almost certainly. And if you've been struggling these last 4 years, maybe since late 2021, early 2022, I think you need to buckle up. Because if you position yourself properly and you put in the work, I think it's going to be a tremendous next 4 years from you that completely goes against your experience these last 4 years. Now, this isn't magic. It's just an economical environment, okay? But it's very helpful to be in that environment when your goal here is to, especially in our industry, okay? When your goal is to make money, when cheap money is at play, the market tends to be a little bit more volatile, a little more upbeat, a little more fearful when things get weird, a little more greedy when things get hot. Okay, develop your trading plan now. Develop an investing plan, loose, but, you know, you're going to bet on America essentially. But develop the plan now so that you've already seen this cycle play out from 2020 to right now, essentially. The next 5 years is very likely to be maybe a slightly more timid version because we had, you know, the pandemic and everything. But these next 5 years are going to be maybe a more timid version, but in reverse. And when the reverse of the reverse, so the one that we've seen the last 5 years of them raising rates hits again, whatever that might be, after the cycle of cheap money has concluded, you will have seen this same thing happen already, and you'll be ready to position yourself in a way where you don't lose everything that you spent these next 5 years making. Okay, this is all going to repeat itself. And a lot of you guys who were caught off guard in 2022 are going to be tremendously positioned the next time around this happens. Not only to make money while money is cheap, but to keep it and maybe continue to make money when they have to start choking everything out again. This is all a cycle. It's going to happen again. All right, market closing there at highs since we've seen the rate cut. We're on a 2-minute chart. So let's keep an eye on this next bar here, minute 50 out. By the way, we are coming up on 230. There is a little bit of added volatility some days. Not every day, like the 250 bar. But here at 230, Central at least. On that rollover, you oftentimes do see a little bit of added volatility. We'll see if we get that here today. We're about 50 seconds out from this rollover. Yeah, ATR right now here on the 2-minute chart. This is, we're sitting at 45 which is tremendously high for a 2-minute chart this time of day. Of course, for good reason here. All right, there's the 230 rollover. Not a whole lot of added volatility to speak of here. All right, guys, well, listen, hey, this is very much so a step in the right direction. 25 BP cut. Inflation will come down to the 2% goal. It's going to take a little bit of time. It's not happening next month. Okay, but everything I just said in my previous rant is very, very true. I think a lot of you guys are much, much better positioned for these next 2 cycles, going back toward cheap money and then choking out the economy yet again than you were, obviously, during the pandemic and everything when it was forcefully done. And then it was just whiplash. Okay, those cycles happened a little too quick, and it caught a lot of people, even experienced people, off guard. This next cycle, make it different. Right, you're going to be able to see it coming because we just saw all of this play out. Put yourself in a position where you can make a whole lot of money while money is cheap, whether it's in trading or in business or both, ideally. And then you hold on to that or even make more when they start constricting the economy again because you see it coming. In 2022, that's what they started to do. Right? We've all been through it at this point. All right, guys. Hey, I'm going to be trading live tomorrow morning for the regular morning show. Subscribe to the channel. Leave a like on the stream on the way out. And I will see you guys in the morning. Very good. Step in the right direction.